You've probably been taught that every time price hits a liquidity level, it will then reverse and seek opposing liquidity. If this was true, the market would permanently be in range-bound conditions. These liquidity sweeps can look clean in theory, but a lot of the times these levels never actually get respected and price just shoots straight through them. If this happens to you, then don't worry, because by the end of this video, I'll show you a real example on a real chart of when these liquidity levels cause a reversal and when you should expect them to get broken through. So let's start with the basics, but don't worry because I'll make this quick. Normal liquidity will be at swing highs and swing lows, and it will be very obvious, such as this high right here and this low right here. Session liquidity will be the highest and lowest point that price was traded during the previous session. So there will be also equal highs and lows, which are pretty self-explanatory. However, you need to add some discretion here, because some people like to be, oh, it needs to be the exact same price to be an equal high or an equal low. To me, like a few dollars difference doesn't really makes a difference to me, right? So if this almost touches the previous high but doesn't really touch it, to me, I'll just consider that equal highs and I'll go on about my day. So liquidity sweep can look like this, where you got price coming to your sell side liquidity, sweeping it with a wick and then immediately reversing. Or it can look like this, where price goes below, closes below the previous sell side liquidity, and then the next candle engulfs it and goes back higher. Session liquidity sweeps will be very simple. You just mark the previous session highs and lows. You wait for price to go there, sweep it, and then possibly cause a reversal. The reversal will not come every time, and this is what I'm going to dive in a little bit. Equal highs and equal lows. Again, like I told you, some discretion. You can see that this candle and this candle right here didn't really touch the previous high, but I consider all of these highs right here to be equal highs. Same thing right here, where it's really clean. You can see these two lows, they touch the line, and this will be your equal lows. But if you try to mark liquidity on your chart, it's not always clean. And a lot of the times this ends up happening where you mark your swing highs right here, price trades through it, sometimes just gives you a small reaction, not even enough for a reversal, and then boom, just goes straight through it, basically ignores your level, and you start to think that these liquidity concepts, they don't really work. However, what you're missing is high time frame context, because this was just a recent high on a bullish trend. So right here, this was 1 minute chart. This doesn't really matter in the grand scheme of things. This liquidity on the 1 minute doesn't really matter if it means that it was a recent high on the 15-minute chart on the bullish trend. Why? Because bullish trends will have higher highs and higher lows. So if you start to mark, oh, this is liquidity, you'll never have that reversal because you're on a bullish trend. And you're on a bullish trend, you expect these highs to go. This is what I like to call internal liquidity, right? And internal liquidity will be current trend, highs and lows that you are expecting it to go. For external liquidity, it will be opposing trend, highs and lows. And this is where you expect some sort of reaction. Not always it will be a reversal. But what really changed my perspective on these levels, it's simple. Its price will go and target the opposing trend, highs and lows. So people that were long and trying to catch an even bigger move to the upside, they'll have their stops right here. And once the trend changes, all these stops need to go, right? We're going to collect all these stops. This will act as a magnet for price to go there. Now, this will usually give you a reaction, like I told you, but usually that reaction is going to be the lower high on the downtrend. But when price visits it next time, you're not expecting for price to do this, right? And then reverse and take this liquidity. No, what you're expecting is for this low to go. Why? Because all of this liquidity was taken. We had the reaction. So next time price comes low right here, this liquidity will be from people that tried to long this small up move, and this liquidity will go. And where do we go next? We go to the previous external liquidity, which will be on the opposing trend, highs or lows. And then the pattern repeats itself, where you got low down here, goes higher. Next time it visits this low, boom, it just goes straight through it. Okay, but if you already knew that, I'm sure this has happened to you where you got price doing what I just taught you really, really well. And then next time it goes, it just sweeps and reverses. And now you're confused because what should I expect to hold? What should I expect to not hold? This was supposed to be the low on the current trend. So these lows were supposed to go. And again, you're missing high time frame context because price didn't bounce from that internal low. That internal low just so happens to be aligned with external high time frame untapped sell side liquidity. And this is where you expect the reversals to come because eventually price cannot just trend up forever and keep taking these highs. There will usually be some highs on the left side of the chart or some lows on the left side of your chart, like these ones right here, that will cause some sort of reaction. And these lows, the higher the time frame they are, the more the reaction they will give. Now, let me jump into the charts and show you a real example. So I'm on the 5-minute time frame now, and this will be the liquidity levels that you should be marking. Clear swing points, highs and lows. Maybe you can even mark this. However, here's a question. Why are we currently reacting from here? To answer that, I'll need to go on the 15-minute time frame, right? And you can see that we just swept these lows and all of these lows right here are getting swept. So trend has now changed to bearish. Market structure is now bearish. And we need to keep this in mind. If you don't know market structure, I have a video explaining everything you need to know about market structure so you can go and see it. So currently market structure is bearish. If you go to the 5-minute like we were before, what am I expecting? I'm expecting some sort of reaction because we just hit this high time frame level. I'm going to let price play out a little bit, and that's quite of a big reaction. So I'm keeping in mind that we are still bearish, right? So price can do anything it wants inside of this range. And then I'm going to wait for some sign. Okay, this is bearishness enough to me. So I got a question for you. With what I've just taught you, we've hit external liquidity level. We go on the 5-minute and the 5-minute is starting to show bearishness. Am I expecting price to sweep this low and give me a reversal up? No, I'm actually expecting price to completely ignore this low and go where? Go to the next high time frame liquidity level, which you can mark right here. And there's even this one down here. So let's go back to the 5-minute. Let this play out for a little bit. Boom. We've hit that level down here. So what am I expecting? Again, I'm expecting a small reaction up. So we're going to let this play out. And usually after a while, this is where you start to get confused. Why? Because you think, oh, we just hit a liquidity level. We're starting to go up. This is the reversal. And you're not keeping in mind the current trend. The current trend on the high time frames is currently bearish. The 15-minute time frame is currently bearish. And even here is overall bearish. So what are you going to do? You're going to mark your swing point right here. This 5-minute swing point right here. I'm going to delete this one just to not cause any confusion. And then you're going to mark your liquidity level right here. What you're not going to do is you're not going to start marking every single low and every single high right here and expect all of these to price to just bounce and give a reaction from there, because then it will just get messy and you don't know what to do. You don't know which levels to trust, which levels not to trust. Is this a sweep? Is this not a sweep? Do I move my level here? Yes, I mean, these are all liquidity levels for sure, but they're weak liquidity levels. They're not supposed to hold or cause any sort of like enormous reversal. So given the fact that we're overall bearish, we've hit this level right here, we had the reaction, I'm going to ask you again the same question. If on the 5-minute price comes down to this low right here, this low right here, and even this low right here, if price comes back to all these three lows, what are you expecting? Are you expecting a reversal from here and then price to go up? Or are you expecting for price to just ignore these levels and go straight down? The answer to that is ignore these levels. Why? Because overall trend is bearish. So all of these lows on the high time frame will be recent lows and you don't expect them to hold. You expect them to go away. So I'm going to let this play out for a little bit more. And then boom, you can see ignored this, and then there's this one right here. What's going to happen? we're going to ignore it anyways, right? So now, high time frame context again. Let's mark it. Let's go to the 1 hour because all of these lows are gone. There's this low right here. And I would say this is a pretty big low. So now this is where you need to be careful. And it's going to be on these levels right here, these extreme levels on high time frame. Even if I go to the 4 hour, this is an extreme level because we just have a massive drop and this is an extreme level. So this is where you need to start to be careful. So we're going to let price play out. Price taps it. You start to see very good signs of bullishness. So again, you're not shorting. What are you expecting? You are expecting that if price comes to this low, you expect it to go, but you're still waiting for your market structure to align again. There's this liquidity level right here. There's all these bullish liquidity levels. I'm going to let price play out for a little bit more. Boom, boom, boom. Let's go to the 15 minutes so it's faster. Okay, we just got a change of the trend. So trend is now bullish. Am I expecting these highs, because the trend is bullish, am I expecting these highs to hold or not? The answer to that is not. You expect this high right here, this high right here, and even this high right here. You expect these to act as magnets for price. Now that the trend is bullish, price will be attracted to these levels right here. You don't need price to come back lower, sweep this low, and then you'll catch the reversal up again. You don't need that, right? Because the trend is currently bullish, and if price comes to this low right here, the trend will now be bearish. What you're gonna do, you're gonna wait, boom, that gives a small reaction right there. Now, question to see if you really learned this. We are currently we swept these highs right here. We even swept these highs right here. And currently it looks like we are going to this high right here. Are you expecting this high to cause a reversal and then go lower? Keep in mind what I taught you, because currently we are on a uptrend, right? High, low, high, low. So are you expecting this internal high right here to hold next time we go and visit and catch a reversal? No, you don't expect it to hold. In fact, you expect it to go and for price to maybe come to this high right there. And if I play this a little bit more, boom, price just shoots straight through it. We sweep this high and now we're having a reaction, right? So question again, if price comes again to this high right here, am I expecting this high to hold? And the answer to that would be no. You can see we come back, we haven't tapped it, and then boom, next time we tapped it, broken straight through. Why? Because this is still an uptrend. And understanding the difference between internal and external liquidity, at least what I like to call it, I don't really know if there's a name for it, but understanding the difference between these liquidity levels is what made liquidity clicked for me. So if you have any questions, you can leave them in the comments and I'll be happy to answer them.